Hi, everyone. Welcome back to Financial Foundations. My name is Shannon Acosta. I'm an advisor in CFP at Benchmark, and Hall Ballinger is joining me today.
Hey everyone, glad to be here.
We're going to talk about stocks, bonds, and mutual funds. We're in June and we're talking about investing this month. So it's important to talk about what you actually invest in when we talk about gaining returns long term in the market. We'll start off with what is a stock. Hall, can you talk a little bit about that for us?
Yeah, absolutely. So a lot of y'all might already be familiar with the stock, but to break it down, it is just a very small piece of ownership in an overall company. And so if a company wants to raise funds for some of their procedures or long-term just overall processes, they'll issue stock and they'll say, hey, we'll give you this little ownership of the company if you give us $100. You can give that $100 to them. And so now you own, and what you have is invested in that company. And so if the company does well, you're going to do well. If the company doesn't do as well, you're not going to do as well. It's a lot of people consider it high risk to invest into a single stock, which is why a lot of 401k investment options don't even offer stocks. They offer mutual funds, which Shannon's about to explain as well. But the stock itself is you are solely invested in that one company. And so if let's say you invested in a large tech company and they came out and do well and their stock went from $100 to $120, you're now 20% richer, however much you had invested in that company. On the flip side, let's also say that it came out and they had some accounting snafus or anything of that nature, and the stock dropped from $100 to $70. You immediately lost 30% overnight. That's a lot of risk to take on with one particular company. So because of that, there's also things called mutual funds. Shannon, do you kind of want to explain the inner workings of mutual funds?
Of course. Like Hall said, when you own stocks, it's important to not just put all of your eggs in one basket and put all of your money in one stock. What you need to do is buy a bunch of different stocks in order to diversify that risk. So if something happens to one of your stocks and it goes down 30% overnight, in Hall's example, I mean, we care, but that's offset and mitigated by the other stocks that you own that might not have responded in the same manner. Excuse me. So a mutual fund is an easy way to own a bunch of stocks at the same time. And then somebody else at the mutual fund company is the one that's doing the stock picking. They're the ones doing the research on when to buy or sell certain holdings. So you can instantly diversify by putting your eggs in about 100, excuse me, to 150 different baskets in one mutual fund. And we do this in asset classes. Asset classes can be broken down by the size of the company that you're investing in.
You can see why we're doing this over Zoom.
There's a little cold going through my house right now. We've got large companies, medium-sized companies, and small companies. You can also invest in mutual funds based on the type of company that is invested in. You can be a company that's growth-oriented, one that's value-oriented, or you can have a fund that is a blend of both of those. Hall, can you talk a little bit about the large, mid, small, growth, blend, value combination in the mutual funds?
Yeah, so like Shannon's talking about, you can have growth, value, or blend. Value also called growth with income, a little interchangeable. And then in addition to that, for each of those asset classes, you can have a small, medium, or large. A small company is normally companies that have assets of 500 million to 2 billion. So still they're not your mom and pop shops in the garage, very established companies, but they're looking to get more market share. So they're going to be more aggressive in nature. Mid-size, mid-cap companies are more that 2 billion to 5 to 10 billion companies. So companies they're not the big players, they're the names you probably haven't heard of, but they're well established. They're going to be a little bit less aggressive than the small cap, but a little bit more aggressive than the large cap. Large cap are companies that are $10 billion in assets or larger. A lot of these are companies that you've heard before: Johnson & Johnson, Coca-Cola, Apple, Amazon. There's lots of them. And so those companies are going to be in that, if they're in that value center, they're just going to want to retain that market share that they currently have. They like what they're doing. They might be a grocery store and they just want to say, hey, hold on to us and we're going to kick off dividends saying thank you for investing in us. If they're on that growth side of the spectrum, they're going to be taking their profits and instead of dividends, they're just going to be reinvesting it back into the company. Your investment, your share of that company is going to rise because they're making profit, but they're just not going to kick you a dividend off. You're still gaining growth either way. It's just different ways to structure a company. And normally growth is a little bit more aggressive than that value side of it. Anything you would add, Shannon?
Well, I think you can also add an international layer over everything that you
Yeah.
just said. So you can have an international small cap fund. You can have an international large growth fund. The international is going to be a little bit more aggressive in nature than anything US based, but it's still an important component of many portfolios. The last thing I'll say about mutual funds is that we covered asset classes, but we can also invest in mutual funds by sectors. Whereas an asset class is a mile wide and an inch deep, a sector fund is the opposite. A sector fund will invest in a really wide array of companies, regardless of size or objective, but they're all going to be in the same industry. So you might have a technology fund or a healthcare fund or a utility fund. These are going to be a little bit riskier than the asset class funds because sectors are a little bit more cyclical in nature. So they're not a bad part of your portfolio, but they're probably a part that you want to pay attention to. And we tend not to weight very heavily in them. There are about 8,000 different mutual funds available. That's quite the shopping trip if you want to go and paw through each of those to figure out which one is right for you. That's a large part of what we do is do the research for you and identify of those 8,000, which 4 or 5 do you need to be in based on a handful of criteria that we monitor and process. So we talked about stocks. We talked about mutual funds that own stocks. We can also jump over to bonds. That's another common investment that folks like to invest in, especially as they may be after post-retirement or aging. I'll talk about bonds if you don't mind.
Yeah, and you mentioned aging post-retirement. Really, we'd encourage just if you're looking for more security as your time horizon gets closer for investing. If you need those funds sooner, normally you want to look to take on a little bit less risk as those funds, those needs approach. And so a bond is pretty much the exact opposite of a stock. When a company wants to raise money and they say, hey, we'll give you some ownership of our company if you pay us $100 for this stock, they're giving away equity. With a bond, they're giving away, or they are now becoming in debt to you. They're going to say, hey, we want to borrow money from you. So let us borrow $950 and we promise to pay you back $1,000 in 3 years. So it's debt. You're now basically the bank to that company. It's a lot more secure than a stock would be because it's not going to fluctuate with whether their earnings are up or down. It will still move, but it's going to move on a much smaller scale. And it's because there is a promise to repay that debt in the future. Unlike with stocks, they can go up or down. But with a bond, they have said, hey, I'm going to pay you 5% for the next 4 years. And that is our promise to you. And so the risk in a bond fund is normally, okay, the risk of this company defaulting on its debt, going out of business, things of that nature. So that level of risk is a lot lower than it would be with an equity. And so bonds, normally you're buying, you can also have bond funds. So instead of just buying one bond from a particular company, also to reduce that risk, you buy into a bond fund that holds maybe 100, 500, 1,000 bonds to diversify that risk of any potential singular company defaulting on their one bond. And so with those bonds, again, you want to use them and not for longer term investing because those returns are not comparative to good mutual funds long term. But if you have needs coming up in the near term future, they're definitely something to consider. And you want to make sure that you're finding where your risk tolerance is. Everyone has a little bit different risk tolerance. And so that's part of the investing journey, is figuring out where that risk tolerance for you lands and how much you're willing to take on versus the potential return down the road. Anything you would add there, Shannon?
No, I think that about covers it. Thank you guys for joining us. Stay tuned in just a moment for important disclosures. Sorry that you had to listen to me cough, but this is Facebook Live, so you get what you get. We appreciate you guys joining us. Now for the disclosures. All investing, including stocks and mutual funds, involves risk, including loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. International investing involves special risks, such as currency fluctuation, political instability, and it may not be suitable for all investors. And because of their narrow focus, sector investing will be subject to greater volatility than investing more broadly across many sectors and companies. Thank you guys. Have a good afternoon.
Thanks for joining.